Yeah, well, I would agree with that. I mean, when we look at Asian currencies, one thing that stands out, and actually the table that you brought up a few seconds ago and the price changes that we've seen this morning tend to suggest this, which is that it's these currencies that are embedded with current account deficits and funding concerns, India being one, Indonesia being the other, that are the underperformers, and we're slightly more constructive on the rest. So the point about India here is well made, such that we always look at India and think to ourselves, well, if the currency is weak, that should be good for Indian exporters. Therefore, it's going to be good for Indian equities. There tends to be a relationship historically between the two. But I think this is a slightly different scenario because this weakness in the Indian currency, there's two things going on here. The first one is that, well, it's not necessarily reflective of stronger economic conditions within India to the extent that it would be attractive for equity investors. Not least because there's a pass-through to inflation that the RBI will have to adjust to in terms of interest rates. So that's something to look out for. But the second point, I guess, is that where does this necessarily end right now for investors? Because this is a dollar move. The dollar-India upside move here is a dollar move predominantly, but India and Indonesia are the two markets that are most at risk here, and we foresee continuation of US dollar strength. So again, on that basis, you have to expect that there's more upside on these currency pairs.
And Dwyfor, do you think the fresh dollar strength that we're seeing against EM currencies today has something to do with that strong jobs number out on Friday? Because if you look at that wage growth print, many are saying, hey, this doesn't suggest that the Fed can ease back at all.
Absolutely right. So, you know, the question mark, I think, over the last couple of weeks has simply been one of, have Trump's words on the Fed had any impact at all in terms of translating into a slightly more cautious Fed hiking cycle going forward? You know, one of the things we've been looking at for a number of years now is this relationship between employment and wages. And it simply has broken down if we compare it with the pre-crisis period. Maybe it's now reasserting itself. And if this implies stronger wage growth and stronger consumption, and that's added on, of course, to the scenario whereby the tax cuts are feeding through as we speak, all of this suggests that actually the Fed really cannot afford to take a backward step here and really has to be on the front foot in terms of its interest rate hikes. So I think, again, when you look at the impact that has in terms of the strength of the economy, what that means for equity inflows into the US, but also on a relative interest rate basis, it is very difficult here to make a case that the dollar upside has actually run its course. This looks to be the continuation of momentum.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.